Welcome to the Arbitration World podcast, in which we focus on significant developments and issues impacting international arbitration. We hope you enjoy this discussion. Please do get in touch with us if you have any questions about this week's episode or any areas you would like us to cover in a future podcast in this series.
Welcome to another in our series of podcasts which are focused on cases, developments and issues impacting international commercial and investment arbitration. This podcast is the third in our mini-series exploring claim finance, looking in this instance at issues that arise at the end of a claim, whether that's success fees or other issues that arise at the end of a claim. Before we get started, some brief comments by way of introduction. This presentation is limited in scope as appropriate for a general audience and applicable time constraints. This presentation is not offered as legal advice, which should be obtained only from properly licensed legal professionals on the basis of the specific facts of a given case. All speakers appear in their personal capacities, and any opinions or views offered are those of the speaker alone and do not necessarily reflect the opinions or views of Kernel Gates, Augusta Ventures, or any other entity or individual. I'm joined today by Andrew Roberts, Head of Construction and Energy at Augusta Ventures. As many of you will know, Augusta is a leading legal finance business which funds claimants in litigation and disputes around the world. Founded in 2013, Augusta is globally networked from three major offices in London, Sydney and Toronto, and has provided over 585 million sterling of capital to enable claimants to bring a wide range of litigation and arbitration claims, with a particular focus on commercial litigation, competition claims, construction claims, group and class actions, and bulk consumer claims. Andrew himself is a litigation and arbitration lawyer by background, having spent 10 years in private practice before joining Augusta 4 years ago. He specializes in construction disputes and heads Augusta's very busy construction and energy team. Thanks for agreeing to participate, Andrew.
Thanks for inviting me in. Very pleased to be here.
In this podcast, we're going to look at what happens at the end of the claim. How might the funder's share be calculated, and how do things work if the claim doesn't go exactly as expected? I'd like to start, if I can, Andrew, with the more positive scenario. The claim is settled or succeeds after a hearing and money is collected from the other party. So the situation that going into the claim everyone is hoping will arise. Can you explain the more common success fee structures that you see these days?
Sure. So I suppose, first of all, just by way of very brief background, just for the unacquainted, funders will get their return from an investment purely from the proceeds of the claim. So the funding is non-recourse, which means that if the claim loses, the funder will get nothing back on its investment. So assuming there are proceeds, the funder's fee will be calculated in the funding agreement that's entered into between the funder and the claimant. So commonly success fee structures will include, first of all, a return to the funder of all the funding deployed in paying the law firm and all other legal expenses associated with running the claim. And then on top of that, a success fee that will either be based on either or a mix of a multiple of the funding deployed by the funder, or an interest rate, for example, on the funding deployed. Alternatively, or on a hybrid basis, an agreed percentage of the proceeds of the claim. And it's normally, if it's one or the other, it'll be the greater of the two. Generally, a funder prices their success fee so that the multiples or interest rates or the percentages to be recovered will increase over time. There's a number of reasons for that. First and foremost, the incremental increase in pricing tracks or reflects the funder's cost of capital. The longer the funder's money is out there, the more it costs. Secondly, it reflects the funder's increased risk as a claim progresses and the claim draws nearer to trial and nearer to that binary outcome, which is why a funder is in the game in the first place. They price the risk, they take on that risk, and that's why their returns are quite significant. So the closer you get to trial, the less chance there is of a controlled settlement, and therefore the higher the pricing that a funder can justify. Furthermore, the incremental increase in pricing will incentivize settlement in some cases. If a client is aware that if they enable the case to go for another 6 months, their success fee payable to the funder will be higher than if they settle tomorrow, it may incentivize them to look for ways to settle amicably, which is always in the funder's best interests generally, as well as, we would say, the claimant's. And lastly, having that incremental increase also ensures that the client is focusing on budget attrition and making sure their legal team are focusing on staying within budget, because of course the more the legal team incurs, the greater the success fee at the end. And that is amplified as the incremental pricing sort of increases over time. So most funders have off-the-shelf pricing options that cover these scenarios. But it's fair to say the more sophisticated funders will often tailor the structure of their success fee to meet the particular priorities of the claimant, whilst obviously ensuring that the funder will receive a reasonable return that compensates it for its non-recourse risk. So, for example, where the risk of a total loss on a case is quite low, relatively speaking, for example, where a funder is funding a cross-collateralized portfolio of claims, or where perhaps the funder is getting on board at the quantum phase of a termination dispute, perhaps where the termination has already been decided on liability in the claimant's favour. A funder might in those circumstances be willing to price lower because its overall risk is lower. And so if you imagine the funder's overall portfolio across its business, if you're putting in a low risk case into that portfolio, you don't necessarily need the same pricing to compensate for the negative impact that case might have across your overall portfolio. So that's the sort of consideration a funder might have when considering pricing.
Can we also just look at what you just touched upon there when you talked about cross-securitization across a number of claims? I mean, if we're looking here, rather than on a single one-off non-recourse funding arrangement where there's just a single claim, if you've got a series of claims, I mean, I'm assuming, does that then drive down the level of the return as far as the client's concerned, make it cheaper ultimately?
Exactly the same principle, Ian. So the more claims you have within a single portfolio, the less risk of an overall nil return. If you've got 5 claims, all with a reasonable prospect of success, the chances of them all failing are pretty slim. And by pooling the proceeds of all of the successful claims within a portfolio, you can recover your funding deployed from the successful outcomes and compensate for any losses. So certainly the risk is reduced, and as a result, typically the funding is cheaper.
And in terms of what you're cross-securitizing, you're in some investment then, yeah? So if you're successful in claim number 3, having failed in claim number 1, when you're securing your return on the 3rd claim, am I right in saying you'd also be recovering your sum invested in the earlier unsuccessful claim?
That's correct. So attractive from a funder's point of view because the risk is reduced, but also from a client's point of view because the funding is cheaper, but also because, the more claims a funder is covering, the more overall saving a client is making for their business. So we certainly championing the portfolio model as much as we can. Certainly in my area of construction, it is increasingly popular.
I mean, I guess that sort of leaps out of the nature of the client, doesn't it, to some extent? If you've got an energy client or a construction client, by the very nature of the business, they're probably going to encounter claims on a more regular basis, and so have a better opportunity to create these forms of portfolio or cross-securitized arrangements, perhaps by contrast with other forms of business operation where a significant international dispute may be a once in every 5 year kind of scenario, rather than a normal part of business. I mean, maybe
Absolutely.
Is it possible to look at some of the other different client priorities that might drive the type of success fee?
Certainly. So actually quite a recent example I would draw upon is we've got a client that has a really fantastic claim actually, but they have as their key priority to try and settle the claim within the first 12 months, and ideally before they even commence proceedings. So their key focus is on ensuring that they have enough room in terms of how much they're likely to give back to the funder in order to significantly compromise on the overall claim value in order to achieve a settlement. So in that particular case, we've been very careful to price as low as possible in that first 12 to 18 months in order to make sure that the client has every possibility of compromising on that damages value and making sure they still take away the lion's share of the return. And the way that we will deal with that naturally is by a slightly steeper climb in increments as the case gets closer to trial, so that overall we're still spreading our risk in the normal way.
When you are going out to your investors and seeking to attract them to invest into your fund, do you have a specific life cycle in mind in terms of how, within what time frame you're expecting to invest into claims, and then how long those claims on average are going to take to work through?
Yes, it very much depends on the investor and on the ultimate end user of their investments, if I could put it that way. So we have one particular investor at the moment that prefers cases that won't go any further than 5 years from the point of inception, because that works best for their portfolio as a whole. We have other investors who have an appetite for much longer investments, and you might get that in the form of a very meaty investment treaty claim, for example, or a very involved competition claim that hasn't been commenced yet and has a number of procedural hurdles. So it really depends on the investor, and the more sophisticated funders will ensure they've got a fairly diversified portfolio of different pools that serve different types of cases and durations.
Thanks for listening to the first part of this two-part edition on claim finance. Please subscribe to hear the next episode in a week's time.
Thank you for listening to this episode of Arbitration World Podcast. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks, that's HUB Talks, in your favorite podcast app. We hope you will join us next time for further discussions on hot topics and significant developments in international arbitration from around the globe.